if we have capitulation because people are just so disgusted with the stocks, gold's up, my stocks are down, and people just decide to sell, or the fair weather friends, the momentum chasers, just get out. Anybody who bought when gold hit that nominal all-time high, and then now they're disappointed because it's corrected, I think the disciplined speculator will take shares off those weaker hands, and especially if you get it, if you're with the program, but you're late to it, I think at times like this are a godsend. When the actual value case is higher, plus or minus $2,000, that's a terrific gold price. And if the stocks are on sale because of sentiment, market sentiment, that's absolutely an opportunity in my view, Charlotte. Whatever variables you're looking at, whatever you think might be, driving gold today, I think basically we set that aside. We look at the macro, and the macro, I think, is we're headed for recession. That's very bullish for safe haven assets, which includes gold and silver. And if the U.S. goes into recession and the Fed reverses before the ECB does, that is also bearish dollar, bullish alternatives. That doesn't have to happen, but if it does, it gives us a good tailwind. So quite clearly, gold and silver. And then the only thing about silver is, it's not that I'm not bullish on silver, but I just want people to understand that silver characteristically in a bull market lags gold anyway, and then catches up at the end. And all I'm saying is it may do that even more so this time because it has this stronger than ever industrial component. On the flip side, though, the same outlook means that we really want to be cautious about anything to do with industrial metals or minerals. So that includes oil. Like there was this big hope that China reopening was going to send energy prices and commodities prices soaring. Didn't happen. It helped oil more than anything else, but it didn't really happen. So if I'm right about a deepening global recession and China is not going to save us, that really tells us to be cautious about anything industrial. The macro says no copper, no lithium, no matter how much demand we see going forward, no oil. I'm very bullish on oil because the ESG crowd is just starving that industry of capital, even though we're not done with oil yet. So, even the most exciting ones with the strongest cases going forward, not in front of the recession. I want to see the recession do its worst, or the worst be priced in. When the recession denying needs to go away before those commodities really get whacked, and that's when I'll be looking to buy. As a contrarian, as a bottom feeder, I want to see capitulation in the broader markets because I think that will whack everything industrial, with the one exception being, of course, uranium, which is baseload power. Unlike copper or oil, uranium is having a great year. I see that as an opportunity. To anybody with the guts to be a contrarian, I'm not saying uranium stocks can't go down, especially if there's a market crash or something. Stocks are stocks. But that only lasted so long. And I think for reasons we've discussed before, only more so now, I'm extremely bullish on uranium, not some when, this year. This is happening now. The long-term contracts that underpin the higher prices are happening now. We see it dragging spot prices higher, even though the broader markets are weak and the energy sector is weak. And I think that will translate to significant gains for uranium bugs by the end of this year. This is a time to be careful. Into that chaos, I have done some research, and if you want, we can go there next. But there's a particular variable that you and I have heard our good friend Rick Roll and others in the business say for many years, that real interest rates are not the only, but the most powerful, the main driver for gold prices over the years. And I have seen this before myself. I have said it probably on your show before myself. It's not just the conventional wisdom, it's a relationship that's been measured in the past. But I have to confess, Charlotte, that I haven't measured it recently until just now. Long story short, what I have found is actually that the long-standing relationship between real rates and gold seems to have come unglued, and not just today or in the current chaos, but over the recent years. And there was a stronger case to be made back in the 70s and 80s in that big gold cycle. So I understand why my mentors taught me this. We did find that over the long haul, actually the nominal 10-year benchmark rate is more highly correlated with gold since 71 to present, it's now more correlated than any of the real rates we looked at. And, quite shockingly, the 2-year also is even more highly correlated, but there's less time on that. And if you think about it, it kind of makes sense. I mean, how do you get real rates? You take some other rate and you subtract inflation from it. But our bond rates, the interest rates, we get those moment to moment. They're electronically tracked second to second. We have information in almost real time on those rates. But inflation's only updated once a month. So you're subtracting the same number all month long until you get the new inflation number. That means for all, 29 out of 30 days, it'll be the nominal rate that's wiggling what we are thinking of as real rates. At the moment, it seems like nominal rates are a more powerful explanatory variable, but we're still seeing plenty of times where the DXY, the takeaway is, be very careful of your assumptions right now. Now, if you want me to make a bullish case, it's not going to be ironclad, here's the data, this proves that here's where we go. Be more macro. As we've been saying, we've heard from our mentors in this business for so long that real rates are so important. And that was great news because real rates for a long time have been negative. The Fed nailed the nominal rate to the floor and inflation was low and then things went negative and they stayed there. So as long as real rates were negative, we could shrug off, whatever other news might happen or even a strong dollar or these other things. But just as of the last CPI and PCE reports, the core rates have gone negative. And that's what the Fed says it's looking at. And on a PCE basis, even the headline rates are negative. So, are now positive. They were negative. They just flipped to positive. So this one thing that we were reassured for so long meant we didn't have to worry about gold. Suddenly, that accepted signal says, well, it's time to worry about gold. So I went to look at it and I found a lot of noise. I was trying to look at real rates. They've gone positive. So what's the correlation look like? And really this year, since real rates have been climbing, guess what? Gold was climbing at the same time. And until just the last couple of weeks when, gold went back, pulled back from 2000. The biggest relevant picture is August of 1971 to present, because that's when gold was freed to trade on the open markets, or you could look at it that way, or that's when the dollar became a worthless abstraction. But anyway, and then I looked at it and just by I was looking at different real rates, and then just by comparison, what's the difference between the nominal rates? And I started looking, and the nominal charts looked better or more explanatory in many cases.